Hey, what's up guys, welcome to my YouTube channel. So in this video we are going to be dealing with the CRT model, which is the candle range theory. I'm going to be teaching you guys how to identify them and how to trade them. So without wasting much of our time, let's get into it. So what is a candle range theory? In a simple definition, a candle range theory is the ideal of using the high and low of a single candlestick from the higher time frame to predict price behavior on the lower time frame. Now let's move over to the example of a candle range theory. So looking at this example, this is what a CRT model should look like. Now we have the higher time frame and we have the lower time frame. Now on the higher time frame, what do we have? We had a bullish candle which was formed. Now where is the range? The range is in between the highest price level and the lowest price level. Now basically what I'm expecting price to do is, after I must have seen this bullish candle closes, I want to be expecting the next candle to open and take out this candle range high. It should still come back in and close as a bearish candle in between the range. I want to be expecting the next candlestick pattern to open and close below the candle range low. It's as simple as it is. So what I want to be doing is, after I must have seen this pattern occurred, I want to be going to the lower time frame. So let's say this is our lower time frame, and this is what? This is the candle range high and the candle range low. This is what it should be looking like on the lower time frame. So after we had that push towards the upside, we saw price came back inside of the range. So basically what I'm expecting price to do is to break out of this very candle range low. After I must have seen that price have broken out of this candle range low, I want to be expecting a retracement, probably on the what? On the supply level, in order to sell. Now mind you, we have a two entry model for this candle range theory. Now the first model is, after I must have seen price broken out of this very candle range low, all I want to be doing is to be expecting price to pull back into that very supply zone that created that break for me to sell. So at this point, let's say this is the supply zone that created the whole move. So basically I want to be expecting price to come back inside of that very supply zone for me to sell. So let's say I want to be shorting at this very level. If price comes back at this very supply zone, I want to be shorting at this point. My SL should be on the supply zone, above that very supply zone, and my TP should be at this very level, below this point. Now for the second entry model is, if suddenly price comes back again, we should expect price to take out this very low. After must have seen the sweep, we're going to be expecting price to take out this point, then tag us in on the next supply zone. I want to be interested to sell at this very next supply level. My SL should be above this very supply, then my TP, my target should be below. These are the two entry model for the candle range theory. Now let's move over to the bullish pattern. So looking at this very example, this is for the bullish pattern, and we are having the higher time frame and the lower time frame. Now on the higher time frame, we are seeing that there is this very bearish candle which was formed around this very point. And now where is the range? The range is in between the highest price level and the lowest price level. So at this point, this is the candle range high and this is the candle range low. So what I'm expecting the next candlestick pattern to do is to open and take out this very candle range low, then close in between the candle range. And after it must have closed inside of the range, I want to be expecting the next candlestick pattern to open and close above the candle range high. All I want to be doing is to be going to the lower time frame. So let's say at this point, this is our lower time frame, and this is what? The candle range low, and the candle range high. And looking at the higher time frame, let's say this candle range low is representing this candle range low on the lower time frame, and the candle range high on the higher time frame is also representing the candle range high on the lower time frame. So now what happened? We have price came back, took out this candle range low. We saw that aggressive push to the upside. So at this point, this is actually the break of the candle range high. So after must have seen this break, I want to be expecting price to pull back at the nearest demand zone for me to buy. And like I said this candle range theory has a two entry model, which is this very one and this very one. So basically, after we saw price broke out of this very candle range high, all I want to be expecting price to do is to come back to that very demand zone that created that break for me to buy. So at this point, this is my first entry model. So I want to be interested to buy at this level. My SL should be at this very demand level, below this very demand level, and my TP should be above this very point. Now, and for the second entry model, that is if price eventually comes back to this very range, we want to be seeing price to take out this very point, because this is more of like a liquidity, then coming on the next or tapping on the next demand zone for us to buy. So at this point, I want to be still interested to buy at this very level. My SL should be below this very demand zone, then my TP should be above. It's as simple as it is. That's how to leverage well trading with the CRT model. So I'm going to be taking you guys to the chart, and I'm going to be showing you guys how to identify this pattern and how to trade them. So looking at the chart on the daily time frame, we are having the candle range formation around this very level. Now what do we have? We had this bullish candlestick pattern which was formed around this very point, and now one is basically expecting the next candlestick pattern to do is to open and take out this very candle range high, then coming back inside of the range to close as a bearish candle. This very point becomes my candle range high. So I want to be marking out the candle range high and as well as the candle range low. So as soon as I've mapped out the candle range high and the candle range low, I want to be expecting the next candlestick pattern to open and close below the candle range low, which is what we see price did around this point. After we saw this very candle opened, we had it close below this very candle range low. So at this point, I want to go to the 1 hour time frame. So looking at the 1 hour time frame, what do we have? We had price came in at that very level, first rejected. Then after the rejection, we had price broke out of that very candle range low. So basically what I'm expecting price to do is to come back at this very supply level for me to sell. So this very supply level is a valid point for me to sell. So what I'm expecting price to do is to come back for me to sell. So if I want to be interested to sell, I want to be interested to sell at this very level. My SL should be above the supply level, then my TP should be below, around this very level, or even below this level. This is for the first entry model. And for the second entry model, we had price came back at the range at this point. So looking at what price is doing at this point, we had price took out this very level. Now as soon as price took out this very level, we had another supply zone which has not been mitigated around this level. So at this point, this becomes my next supply zone which I'm interested to short. So if I want to be interested to sell, I want to be interested to sell at this very level. My SL should be above the supply level and my TP should be below. So looking at what price did at that point, we had price took out this level. This is more of like a liquidity. After price took out this level, we had price came in on that very unmitigated supply zone. Then after we saw price came inside of that zone, we saw the rally towards the downside. And this is how to leverage well trading with the CRT model. So we are going to be moving over to the bullish pattern. So this is for the bullish pattern. And on the daily time frame, we are having the candle range formation around this very level. So what do we have? We had this very bearish candlestick pattern which was formed around this very level. So basically what I'm expecting the next candlestick pattern to do is to open and take out this very candle range low, then comes back inside of the range and close as a bullish candle. So at this point, this very level becomes my candle range low. So what I want to be doing is to mark out the candle range low and the candle range high. So after this bullish candlestick pattern must have closed, what I want to be expecting the next candlestick pattern to do is to open and close above the candle range high. It's as simple as it is. I want to be expecting this very next candlestick pattern to open and close above the candle range high. As soon as price closes above this candle range high, I want to be going to the lower time frame, which is the 1 hour time frame, to look at for my entry opportunities. So at this point, I want to be going to the 1 hour time frame. So on the 1 hour time frame, what do we have? We had a break out of the candle range high. So after I must have seen this very candle range high, which was taken out, I want to be drawing out my demand zone around this very level, because this is the nearest demand zone around this point. So what I want to be expecting price to do is to come back at that very demand zone for me to buy. It's as simple as it is. This is the first entry model. So what I basically want to be doing is, if I want to be interested to buy at this very level, I'm going to be interested to buy at this point. My SI should be below the demand and my TP should be above. That's how to leverage well on this very entry model. And for the second entry model, what we are expecting price to do is to come back, take out this very level, then tag us on this very demand zone for us to buy. But price didn't actually make it there. But we also saw another entry opportunity around this level. After we saw price broke out of this very level, we had another liquidity which was formed at this level. So now basically what I'm expecting price to do is to come take out this very level, then tag us on this very demand level for us to buy. So if I still want to be interested to buy at this point, I want to be interested to buy around this very level. After I must have seen the liquidity take out, I'm not interested to buy at this level. My SI should be below that demand and my TP should be above. And that's basically how to leverage well trading with the CRT model. So if you found this helpful, don't forget to like, subscribe, and also turn on the notification bell so you don't miss out on any of my trading insights. Alright, thank you and see you on my next video.